The Most Important Thing Illuminated, by Howard Marks. Introduction. Picture this. It's the late 1960s, a time of incredible optimism in America. You've just landed your first job on Wall Street, and you're surrounded by the smartest minds in finance. They've come up with a foolproof strategy for getting rich. It's simple. Identify the 50 best, most innovative, fastest-growing companies in America, companies like IBM, Xerox, Polaroid, Coca-Cola, and buy their stock. Don't worry about the price. Just buy them. They called them the Nifty 50. These weren't just good companies, they were great companies. They were the titans of industry, the engines of progress. The thinking was that if a company was growing fast enough, and its quality was high enough, the price you paid for its stock simply didn't matter. Over time, its growth would justify any price. It was the sure thing. The closest thing to a guarantee you could get in the unpredictable world of investing. So, people piled in. They paid prices that were 80 or 90 times the company's earnings, when the historical average was closer to 15. They felt brilliant. They felt safe. For a while, it worked. The stocks kept going up. And then, in the early 1970s, the music stopped. The economy soured. Inflation soared. And the Nifty 50 collapsed. Those brilliant, foolproof stocks, the best companies in America, lost 90% of their value. 90%. Imagine putting your life savings into what you believed was the safest bet in the world, only to see it evaporate before your eyes. What went wrong? The companies were still great. But the investors had forgotten the most important thing. That's the central mystery that our guide today, Howard Marks, has spent his entire life solving. Marks is a living legend in the investment world. He's the co-founder of Oak Tree Capital Management, a firm that manages over $100 billion, and he's revered not for being the flashiest investor, but for being one of the wisest. He's the person the smartest people in the room turn to when they're scared, because he has mastered the art of navigating risk. His book, The Most Important Thing, isn't a get-rich-quick scheme. It's something far more valuable. It's a philosophy. It's a way of thinking that protects you from the kinds of emotional and psychological traps that led to the Nifty 50 disaster, and countless others since. So, what I promise you today is this: by the end of our time together, you will understand the fundamental difference between how average people think about investing and how the masters think. It's a shift in perspective so profound that it applies not just to your money, but to how you make decisions in every area of your life. It's the secret to moving beyond simple, first-level thinking and embracing the deeper, more powerful wisdom of the second level. Book summary. So, let's start where most people do. What's the oldest rule in investing? It's so simple we've all heard it: buy low, sell high. It seems obvious, right? Who would ever try to buy high and sell low? But here's the first question a master thinker like Howard Marks would ask. What does low even mean? And what does high mean? Most people, what Marx calls first-level thinkers, have a very simple answer. Low means the price is down. High means the price is up. Or they might say, it's a great company, so I should buy the stock. This kind of thinking is simplistic and superficial. It's the kind of thinking that gets you into trouble, because it's the same way everyone else is thinking. And as Marx reminds us, if you think like everyone else, you're going to get the same results as everyone else. And those results are rarely spectacular. To be a superior investor, you have to think on another level. You need what he calls second-level thinking. A first-level thinker says, it's a good company, let's buy the stock. A second-level thinker says, it's a good company, yes, but everyone thinks it's a great company. It's the talk of the town. Because of that, the stock price has been bid up to a level that's no longer reasonable. It's overrated and overpriced. Let's sell. You see the difference? The first-level thinker is looking at the company. The second-level thinker is looking at the company, and the price, and what everyone else thinks about the company and the price. It's deeper, more complex, and it takes into account a crucial element that most people ignore: human psychology. Investing, Marx says, is not a science. It's an art. And the reason it's an art is because markets aren't driven by formulas and spreadsheets alone. They are driven by people. And people are driven by emotion. Marx paints a beautiful picture of this. He says you should imagine the market as a giant pendulum. It's constantly swinging back and forth between two extremes. On one side, you have euphoria. This is when everything is going great. People are optimistic, they believe the good times will last forever, and they forget about risk. They are driven by greed, by the fear of missing out on easy money. During this swing, they're willing to pay any price for an asset. This is the world of the Nifty 50, or the dot-com bubble of the late 90s. But a pendulum never stays at one extreme. The very energy that pushes it to the peak of euphoria creates the force for its swing back in the other direction. And on that other side, depression. This is when there's chaos all around. The news is terrible. People are pessimistic, they believe things will only get worse, and they are paralyzed by fear. They don't want to buy anything, no matter how cheap it is. They just want to sell, to get out, to stop the pain. The pendulum, Marx notes, spends very little time in the middle, at the happy medium where things are priced fairly. It is almost always swinging toward one of these emotional extremes. The average investor rides this pendulum. They get greedy when others are greedy, and fearful when others are fearful. They buy near the top, when euphoria is at its peak, and they sell near the bottom, when panic has set in. They are part of the herd. The superior investor, the second-level thinker, does the exact opposite. They understand the pendulum. They know that when it swings too far in one direction, it is bound to swing back. So, they use the emotions of the crowd as a signal. When everyone else is euphorically buying, they become cautious and start to sell. And when everyone else is panicking and selling, they get their shopping list ready and start to buy. Warren Buffett, a friend and admirer of Marx, put it perfectly: be fearful when others are greedy, and greedy when others are fearful. This is the mantra of the contrarian. It's about being brave enough to stand apart from the crowd. But this leads to a critical question. If you're going to bet against the crowd, you need an anchor. You need something solid to hold on to when the emotional storm is raging. What is that anchor? For Howard Marks, that anchor is one simple thing: a deep understanding of intrinsic value. You have to know, with as much certainty as possible, what an asset is actually worth. Not what its price is today, not what people hope it will be tomorrow, but what its fundamental, underlying value is right now. This value is based on tangible things: its assets, its earnings, its ability to generate cash. Once you have a firm grip on what something is worth, the rest of the game becomes much clearer. The goal is no longer to guess which way the market will go. The goal is to buy things for significantly less than they are worth. This gap, the difference between the intrinsic value and the price you pay, is what Benjamin Graham, the father of value investing, called the margin of safety. Think of it like building a bridge. If you calculate that a bridge needs to hold 10,000 pounds, you don't build it to hold exactly 10,000 pounds. You build it to hold 20,000 pounds. That extra capacity is your margin of safety. It's what protects you if your calculations were a little off, or if an unexpectedly heavy truck comes along. In investing, it's the same idea. If you calculate that a company's stock is worth $100 per share, you don't buy it at $98. That doesn't leave you much room for error. Maybe you'll wait until you can buy it for $60. That $40 difference is your margin of safety. It's your protection against a future that is, and always will be, uncertain. It means that even if things don't go perfectly, even if the company's earnings dip, even if the economy slows down, you still have a good chance of not losing money. And if you're right about the value, well, that's when you make a great return. This brings us to one of the most powerful and counterintuitive ideas in the entire book, the paradox of risk. Most people, and even many academics, think about risk all wrong. They define risk as volatility, how much a stock's price bounces around. Marx says this is nonsense. Volatility isn't risk. A price bouncing up and down doesn't mean you're going to lose your money. The only risk that truly matters, he says, is the risk of a permanent loss of capital. The risk that you put your money into something and you don't get it back. So where does this risk come from? Does it come from buying bad companies? Not necessarily. A low-quality company can be a fantastic investment if you buy it cheap enough. Does it come from a bad economy? Not always. You can lose a fortune even in good times. No, Marx argues, the greatest investment risk comes from one single thing: paying too high a price. It's that simple. And what causes people to pay too high a price? The belief that there is no risk. And this is the paradox. Risk is highest when the widespread perception of risk is lowest. Think about that for a moment. When everyone believes an investment is a sure thing, when they feel safe and secure, that is the single most dangerous time to invest. Why? Because when nobody is worried, they become complacent. They stop demanding a margin of safety. They get greedy and are willing to pay any price. And a high price, by its very nature, means your potential return is lower and your risk of loss is higher. It's like the driver of a giant, heavy SUV. They feel so safe surrounded by all that steel that they might start driving a little more recklessly. They text, they speed, they pay less attention. The feeling of safety actually creates danger. Conversely, risk is lowest when the perception of risk is highest. When there is blood in the streets, when the news is terrible, when everyone is panicking and convinced the world is ending, that is the safest time to invest. Why? Because fear has driven prices down to absurdly low levels. At that point, all the bad news is already baked into the price. The margin of safety is enormous. This is what Marx calls the perversity of risk. It's completely backward from how most people think. They feel safest when they're taking the most risk, and they feel most terrified when the opportunities are greatest. This understanding changes everything. It means your job as an investor isn't to find the next hot stock. Your job is to be a psychologist. It's to take the market's temperature. You have to look around and ask, are other investors optimistic or pessimistic? Are they greedy or fearful? Are they eagerly buying everything in sight? Or are they running for the hills? The answers to these questions tell you far more about the level of risk in the market than any complex financial model. When capital is easy to get, when deals are being done left and right, and when everyone is talking about how much money they're making, that's when you should be most cautious. And when capital is tight, when nobody can get a loan, and when your friends are telling you they're pulling all their money out of the market, that's when you should be aggressive. This doesn't mean you can predict the future. Marx is very clear about this. He belongs to what he calls the I don't know school of investing. He believes that trying to predict the direction of the economy or the stock market is a fool's errand. There are, as he quotes the famous economist John Kenneth Galbraith, two classes of forecasters: those who don't know, and those who don't know they don't know. So, if you can't predict the future, what can you do? You can prepare. You may never know where you're going, he says, but you'd better have a good idea of where you are. Knowing where you are in the cycle, knowing whether the pendulum is closer to euphoria or depression, is the key. It doesn't tell you what will happen tomorrow, but it tells you what the odds are. It tells you whether you should be playing offense or defense. And for Marx, the choice is almost always defense. He uses another brilliant analogy, this one from the world of tennis, originally from an analyst named Charlie Ellis. Professional tennis, he says, is a winner's game. The top players like Federer or Nadal win matches by hitting incredible, powerful shots that their opponents can't return. They win by scoring points. But amateur tennis, the kind you and I play, is a loser's game. The winner is usually the person who makes the fewest mistakes. You don't have to hit brilliant shots. You just have to consistently get the ball over the net and keep it in play, and wait for your opponent to hit it into the net or out of bounds. You win by not losing. Investing, for most of us, is a loser's game. The path to long-term success isn't about hitting home runs. It's about avoiding strikeouts. It's about not having those catastrophic losses that wipe out years of hard work. If we avoid the losers, Marx says, the winners will take care of themselves. This defensive mindset is what ties everything together. It's why you insist on a margin of safety. It's why you are skeptical when everyone else is euphoric. It's why you refuse to chase high returns in a low-return environment. It's why you have the humility to admit you don't know what the future holds, and therefore you prepare for a range of possibilities instead of betting everything on just one. But being a defensive, contrarian investor isn't easy. It requires tremendous patience and courage. Warren Buffett uses the metaphor of baseball's greatest hitter, Ted Williams. Williams knew that his odds of getting a hit were dramatically higher when he only swung at pitches in his sweet spot. An investor has an even bigger advantage than a baseball player. In investing, there are no called strikes. You can stand at the plate all day and let thousands of pitches go by. You can wait and wait and wait for that one perfect pitch to come right into your sweet spot, that moment when you find a great asset selling for far less than it's worth, at a time when everyone else is looking the other way. This is what Marx calls patient opportunism. It's the understanding that the market isn't an accommodating machine. It won't provide high returns just because you need them. So you have to be willing to wait. Sometimes, the most profitable thing you can do is nothing at all. This can be incredibly difficult. It means you will have to endure long periods where you look wrong. When a bubble is inflating, and your neighbors are getting rich buying .com stocks, you, the disciplined value investor, will be sitting on the sidelines. You will feel foolish. You will be tempted to give in, to capitulate, and to join the party. This, Marx says, is the ultimate test. He tells us one of his favorite adages, being too far ahead of your time is indistinguishable from being wrong. Holding a position that is deeply out of favor requires fortitude. But if your analysis of the value is sound, and your margin of safety is large, you have the anchor you need to hold on until the pendulum eventually swings back in your favor. Because it always does. In the end, all of these most important things are really just different facets of one, single, overarching idea. Successful investing isn't about mastering finance, it's about mastering yourself. It's about understanding that the biggest risks don't come from the balance sheet, but from your own human psychology and the psychology of the crowd. It requires a deep humility. The awareness of what you don't know is one of your greatest assets. It keeps you from making arrogant bets on an unknowable future. It forces you to be prepared, to diversify, to insist on a margin of safety. As another famous investor, Sir John Templeton, once said, "To buy when others are despondently selling and to sell when others are euphorically buying takes the greatest courage, but provides the greatest profit." That is the journey of the second-level thinker. It's a lonely path, and often an uncomfortable one. But as Howard Marks has shown through his entire career, it is the only dependable path to lasting success. Commentary. As we step back and think about everything we've just explored, what's the big takeaway? To me, the genius of Howard Marks isn't that he's invented some secret formula for picking stocks. It's that he has given us a timeless framework for thinking about uncertainty. And that's a skill that goes far beyond the world of finance. We live in an age that celebrates certainty and boldness. Pundits on TV shout their predictions with absolute confidence. Social media is filled with people who claim to have all the answers. In this environment, the three most powerful words you can learn to say are, "I don't know." There is incredible strength in that admission. It's not a sign of weakness, it's the beginning of wisdom. When you accept that you can't predict the future, you stop trying to. Instead, you start preparing. You build a margin of safety into your decisions. You think about the worst-case scenario not to be paranoid, but to ensure you can survive it. You become a defensive player in a world that's obsessed with offense. And this applies to everything. It applies to your career choices, to your relationships, to your health. The world will always be a chaotic and unpredictable place. Things will go wrong. Luck, both good and bad, will play a huge role in your life. The question is, have you built your life in a way that allows you to withstand the bad luck and take advantage of the good? Do you have a margin of safety? The lesson of the 6-foot-tall man who drowned crossing a stream that was, on average, 5 feet deep, is a lesson for life. Averages can be deceiving. It's the extremes that can ruin you. Marx teaches us to respect those extremes and prepare for them. So, how can a young person, just starting out, begin to cultivate this mindset? Here are a few simple things you can start doing today. First, become a student of history and psychology. You'll quickly see that while technology and economies change, human nature doesn't. The same patterns of greed and fear that caused the Dutch tulip mania in the 1600s were at play during the dot-com bubble of the 1990s and the financial crisis of 2008. Understanding these patterns gives you a superpower, the ability to recognize them when they inevitably appear again. Second, practice second-level thinking in your daily life. The next time a new phone, a new movie, or a new trend becomes wildly popular, stop and ask the second-level questions. Okay, everyone loves this. Why? What are they seeing? More importantly, what might they be missing? Is the reality as good as the hype? This simple exercise trains your brain to look beyond the superficial and to think like a contrarian. And third, and perhaps most importantly, cultivate patience. We live in a world of instant gratification. We want results now. But as Marx shows, the greatest opportunities often come to those who are willing to wait. The ability to sit quietly and do nothing when there is nothing worth doing is one of the most underrated skills in any field. Ultimately, the most important thing is a book about wisdom. It's about the wisdom to know what you don't know, the courage to stand apart from the crowd, and the patience to wait for the right opportunity. It teaches you that success isn't about being right all the time. It's about being right when it matters most, and surviving the times when you're wrong. That's a lesson that can build not just a great investment portfolio, but a great life. That was a journey through the most important thing illuminated by Howard Marks. We've touched on some of the core pillars of his philosophy today, but I'll be honest with you, a summary is like looking at a postcard of the Grand Canyon. It gives you a sense of the scale, but it can never replace the feeling of standing on the edge and seeing it for yourself. The real magic happens when you read the book. It's in the quiet moments, when a particular story or a simple phrase hits you in a way you didn't expect. This summary is designed to help you decide if this book is worth your time. If anything we've talked about today has struck a chord with you, I truly encourage you to grab a copy. Reading it isn't just about learning, it's an experience that can genuinely change the way you see the world and make decisions within it. You can find a link to the book in the description below. Also, if you found this summary valuable and it gave you something to think about, Please do me a favor and hit that like button and subscribe to the channel. It lets me know that these deep dives are helpful, and it ensures you won't miss our next journey into another life-changing book from the billionaire's bookshelf. Let's keep growing together.